This is nuts, but the United States might run out of buyers for US Treasuries, which might mean the Federal Reserve is going to turn on the money printer again to prevent the US government from going bankrupt. I kid you not, this is what Credit Suisse is predicting, a very particular analyst who has a really good thesis for this. Listen to this because it's nuts, and in the video we'll even talk about how to prepare yourself. Quantitative tightening has just begun. In fact, if you look at the St. Louis Federal Reserve, you can see on their website that the Federal Reserve's balance sheet has absolutely exploded from under $1 trillion leading up to the 2008 recession, exploding to nearly twice that following the 2008 Great Recession. We then saw their balance sheet run up to nearly $5 trillion by 2015. And then, of course, when the money printing and the stimulus happened after COVID, we ran up to $8.9 trillion in total assets on hand at the Federal Reserve. Now, we've started the quantitative tightening process. As you can see here, the line has started to go down slightly. And the Federal Reserve has gotten rid of a good old about $400 million worth of bonds on their balance sheet. This is an example of tightening. This is basically the Federal Reserve saying, hey, you know what? We're just not going to renew the treasuries on our balance sheet as much. We're just going to start rolling them off to the tune of maybe $90 million a month. And this is roughly what they've started doing. Now, the question is it possible that the Federal Reserve ends up having to actually go in the opposite direction and start printing money again as we walk into a recession? This is exactly what Credit Suisse believes the Federal Reserve will do, not because they need to stimulate the market, but to prevent the United States government from going bankrupt. Yup, kid you not, we've got a few problems for the government. See, the federal government projects to have about a $1 trillion deficit per year for the next decade. And the current debt ceiling is about $31.4 trillion. And guess what, folks? We are about $69 billion away from hitting exactly that debt ceiling. You can see that here. The right line is the total public debt that we have subject to the limit. And the statutory level is right there. And guess who might stand in the way of raising this debt ceiling, which we think we might hit that debt ceiling limit somewhere around the summer, maybe July of 2023. Well, if you thought it was easy to get stuff done in Congress, your thoughts should have been extinguished when you saw how hard it was just to get House Speaker Kevin McCarthy elected. It took 15 rounds of voting just to get the House Speaker elected. That shows you how thin the Republican majority really is in the House of Representatives. This hasn't really happened since once in the 1920s, but more commonly back in the 1800s. This is pretty remarkable. But imagine trying now to get a debt ceiling increase through the House of Representatives. Might not happen. And this is really interesting because in order for the government to actually fund its expenses to keep the government functioning, the government slowly reduces the debt ceiling. But by increasing the debt ceiling, what they actually end up having to do is agree to create more treasury bonds. That's basically the way it works. What they do is they say, hey, we need another $100 million today. What are we going to do? Oh, how about we just issue a bond and we'll just promise to repay people $100 million. So we'll just issue a promise, a piece of paper. We'll call it risk-free because historically it has been. We'll slice it up into little $1,000 sections and individuals can go buy these treasury bonds and we'll pay them interest on that. But basically we just kind of created money out of nothing. So we do expect the debt ceiling to get raised so the Treasury Department can generate more of these bonds and fund the government. How much it gets raised will be up for a debate. But what's crazy is, who's going to buy these bonds? What if people stop buying these bonds? Who comes in to buy the bonds when the government stops having buyers for the Treasury bonds? Well, that's where Credit Suisse believes it's the Federal Reserve. So as the government knocks on the door of bankruptcy, it's possible the Federal Reserve may have to come and start turning the money printers on again and end quantitative tightening early, solely to support the actual function of the government. Now that's fascinating, because you might think to yourself, well, who's buying treasury bonds today? And isn't it possible that, the people buying treasury bonds today will just be here to go buy those treasury bonds? Maybe. But according to Credit Suisse, the first issue that we face, there are 3 issues we face in terms of, actually 4 issues that we face in terms of ordinary classic buyers of treasuries, okay? So the classic buyers of treasuries. The number 1 classic buyer of treasuries are people who need to, or institutions who need to garner some kind of yield from the cash that they have available. Well, the problem with that is the Federal Reserve has this thing called the reverse repo depository account. And basically, banks and institutions have been depositing more cash in the reverse repo market since about March of 2021. That's why this line has been going up so much. And the rate on these reverse repos is basically your Fed funds rate divided by 360. That's how much you get paid per night. So think about that for a moment. That's your banking year is 360 days. So if you get paid 5% because the Federal Reserve has raised rates to 5%, and you get paid this every single day, well, that's better than a 10-year treasury yielding you 3.75, or even a 2-year treasury maybe yielding you 4.25 on the day rate, right? You would make more money, obviously, from the reverse repo than you would from investing in treasuries. So in other words, because of the repo rates and the Federal Reserve raising interest so much, you actually end up killing one of your primary buyers of treasuries, people who just want to park money overnight. So that buyer goes away. Then Credit Suisse suggests that banks are unlikely to be buyers, so they're going to go away because they're already holding a bunch of underwater bonds and they've kind of gotten screwed, and instead they're taking their excess cash, and what are they doing with that? They're putting it into the reverse repo market. So number 2 goes away. Foreign exchange buyers are starting to get priced out because even though the dollar's come down a little bit recently, it's very, very expensive compared to historical norms. So there's this argument that less foreign buyers might come, and maybe there's even less of an appetite to buy treasury bonds in the United States, maybe to diversify a little bit more away from those. And finally, geopolitical events have also led to large FX reserve managers reducing their appetite for treasury debt. Number 3 and 4 being somewhat correlated, somewhat similar to each other, right? So Credit Suisse is making this argument that your classic buyers for treasuries are potentially going away because A, you've got a bunch of people or institutions able to just throw money into the reverse repo market, in which case, why bother buying treasuries? So who's left then? This is potentially, as Credit Suisse calls it, a checkmate-like situation. First, use that coupon code JET down below before prices change. There'll be another big price change coming this month, so make sure you get in before the expiration. We just released a bunch of new content, whether you're a hustler looking to increase your income, that is, you're employed or you're self-employed looking for some potential new tax benefits or ways to optimize your business, check out that program. You could also check out the 0 to Millionaire Real Estate Investing course to make sure you're on the right path to buy this dip in real estate. Stocks and psychology of money, building that long-term wealth, looking at pricing, power stocks, and fundamentals for companies. Make sure to check all of those programs out, linked down below. This is potentially, as Credit Suisse calls it, a checkmate-like situation where the Federal Reserve has to end up coming in and buying treasuries again. And they could do this under the guise, Credit Suisse says, of what's known as yield curve control. Now that's really interesting and a very fascinating phrase, because what just happened in Japan? Well, if you don't know what just happened in Japan, allow me to indulge you. So here's how yield curve control works. Run with me on this. I'm gonna keep it as simple as possible, okay? 10-year treasury in the United States right now is like 3.5%, 3.7%, somewhere around there. Let's say the government comes in and says, we don't want it to go any higher than 4%. So they actually set a cap. They're like, we don't want that number to go over 4%. And the reason you might not want it to go over 4% is because even though you want to tighten markets a little bit, you still want to be accommodative to the market, right? You don't want to completely tighten financial conditions to where you have rates so high and so expensive that you walk into a recession. This is what Japan is doing. They don't want another lost decade. They want to keep stimulating their economy at least somewhat. And so what they do is they institute a yield cap. And anytime interest rates start approaching that yield cap, they push yields down. They can push yields down by buying bonds. Quantitative easing. They buy bonds, making bonds more expensive, pushing yields down. Now, everything's been pretty ordinary in Japan in 2020 and 2021. Things have moved or pretty much been respecting of the yield cap, and things, the yield cap has been kept pretty low. This is somewhere around 0.25%. But it started breaking the yield cap line on the right side. That's because people started dumping Japanese bonds, and maybe they're buying US bonds or other bonds. So Japan said, okay, well, let's just be less stimulative to our economy. Let's raise the cap. Nobody was expecting that cap to be raised. And that worked temporarily as the Bank of Japan started buying bonds and pushing those yields down. That's kind of what we've seen over here. But the futures pricing is problematic because the futures pricing suggests basically the Bank of Japan is going to have to raise the cap again, or they're just going to have to keep printing and printing and printing more money, overstimulating potentially the economy again, or trying to overstimulate the economy again, introducing all of this flood of money into the economy just to keep yields where they want them to be. This is roughly the same thing that you could see happen in the United States, but with a slightly different story. The Fed basically comes in, and let's say the 10-year Treasury yield is trading for, let's just say it's at 3.5%. And then all of a sudden, the Treasury market starts becoming disorderly, and the Fed needs to buy bonds so the government can function and not go bankrupt. Well, the Fed could just go, we don't want 10-year Treasury yields to ensure ordinary functioning of the market to go any higher than 3.25%. And so therefore, in limited amounts, we are going to buy 10-year Treasury bonds, and we're going to push those yields down. Meanwhile, the Treasury Department gets the money they need because nobody else is buying the Treasury bonds. Remember, when the Fed buys Treasury bonds, the U.S. government gets the money. The U.S. government is like, yes, here we have money to spend, and now we can send this money to Ukraine, or whatever they want to do with the money, right? So in other words, the Fed once again could become the lender of last resort for the U.S. government. And they could do that by pretending to actually want to institute yield curve control when really what they're actually trying to accomplish is an ordinary bond or like an orderly bond market. Now, what other massive market in the world, like the fifth or sixth largest economy in the world, just had to institute bond buying, which again is stimulative, during inflationary times? Well, remember the United Kingdom? They just went through exactly that. Liz Truss of the United Kingdom spent 44 days in office, and during her 44 days, she kind of screwed up the bond market because her Chancellor of the Exchequer, which is kind of like the Treasury Secretary, Kwasi Kwarteng, he came out and said, "We are a nation of entrepreneurs." Okay, I don't know why I'm going angry German here, but he basically came out and said, we're a nation of entrepreneurs, and we are going to stimulate our businesses. We are going to lower the top tax rates to motivate and incentivize people to work, and we're going to take in less money and we're going to spend more. And the bond market's like, y'all going to take in less money and y'all going to spend more money? F it, I'm out. I'm out. That's what the bond market did in the United Kingdom, which when people are like, I'm out, what do? They sell their bonds. The selling of the bonds all of a sudden plummeted the value of bonds. Yields skyrocketed on the bonds, making the financial system really, really tight. And because the values of these bonds fell, margin calls at institutions are going off all over the place, to the point where margin call-based institutions, like who actually handle these transfers and the settlement of these exchanges, didn't even have enough hours in the day to process all of the margin calls that were happening. Pension funds were on the doorstep of bankruptcy because their bond values had plummeted so much. And all of a sudden, who comes in to save the day as the British pound loses a ton of value and hits parity with the dollar because people are like, I'm out. Get me out of the United Kingdom. It's unstable. Dump the bonds. Dump the British pounds. Who comes in to save the day? Well, October 11th, you get the Bank of England, who makes a statement. Dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to financial stability. Therefore, we are widening our purchases of gilts, basically treasuries, in the United Kingdom for 3 days, and we will buy an unlimited amount of bonds. I'm paraphrasing the sort of last sentence there. But anyway, that the Bank of England's bailout and the ouster of Liz Truss, who's now been replaced by Rishi Sunak, who's now fighting with nursing unions on pay increases and promising to cut spending of the prior administration and reducing debt and reducing expenses. Pound's back up over 22%. Things are stable again, right? But it shows you that if the United Kingdom can have a bond market collapse like that, could we potentially see the Federal Reserve have to really come bail out the United States to actually provide liquidity to the treasury market? Is it possible that treasury yields could spike as nobody starts buying treasuries and people or institutions instead park their money in the reverse repo field as all of a sudden those yields or rates are even higher? Yes, it's absolutely possible. So bottom line out of all of this is as inflation continues to trend down, and rates go up, you might have more people with money move their money into stocks and less money into bonds. The people who would ordinarily buy bonds might put that money into the reverse repo market. Now you don't have buyers for treasuries or too few buyers for treasuries. Now the Fed has to step in, or they risk yields spiking on treasuries and financial instability in markets. So what does the Fed do? Well, they don't want instability. They come in and they start printing money again. And all of a sudden, this whole monetary experiment of print money forever continues. And then we go into the next iteration of QE forever, where basically we never get the Federal Reserve's balances down because now just for the Treasury market to actually function, the Fed has to bail everyone out. This is insane. And it could come, well, to a TV screen or computer screen near you within the next 6 to 12 months. How do you prepare yourself for that? Well, this depends how you want to position yourself. Some say the beneficiaries of this would actually be the stock market. Now, where you want to position yourself in there is up to you. Personally, it seems like some of the benefit would go to bonds because you'd have a lender of last resort coming to buy. It's possible the value of those could actually fall before that ever happens. So kind of speculating there. Maybe you just look for long purchases like pricing power stocks that you can kind of buy and hold on to and build your sort of exposure to in a recessionary environment as hopefully we rotate out of this madness. And maybe inflation goes away, and what does the Fed end up doing after this financial instability? Well, Fed starts cutting rates. Because then you start seeing the reverse repo rate segment go down below where the treasury market is paying. People buy treasuries again. Rates continue to get cut. Maybe treasuries fall more, and you kind of get the stair stepping down. And the Fed is pretty careful about ever launching QT again, or does so in even softer ways until we get those yields slowly coming down again. All of that I expect would actually be beneficial for the stock market. But it could honestly take another year for that to happen, but here's sort of a manuscript of what could be coming down the pike and what Credit Suisse is expecting for the US bankruptcy. Hey, if you like my perspective or how I explain things in this video, check out the programs on Building Your Wealth linked down below. I'm confident you won't regret joining the programs, and I'm so excited to have you, whether you're looking to build your income through the Elite Hustlers course, do-it-yourself property management, rental renovations for real estate agent course, 0 to millionaire real estate investing, or stocks and psychology of money, all very popular programs linked down below.